Should you buy a spot Bitcoin ETF? Weighing the potential and pitfalls. The arrival of spot Bitcoin exchange-traded funds, ETFs, in October 2021 marked a watershed moment for the cryptocurrency. These ETFs offer investors a regulated and potentially safer way to gain exposure to Bitcoin compared to buying directly on crypto exchanges. But with Bitcoin's notorious volatility and the inherent risks of any novel financial instrument, the question remains: should you buy a spot Bitcoin ETF? This article delves deep into the merits and drawbacks of investing in a spot Bitcoin ETF, helping you make an informed decision based on your risk tolerance, investment goals, and overall financial landscape. What are spot Bitcoin ETFs? Spot Bitcoin ETFs, unlike futures-based ETFs, hold the actual Bitcoin in their underlying assets. This means their share price directly tracks the real-time market price of Bitcoin, minus any expenses and fees associated with the fund. They trade similarly to traditional ETFs on regulated exchanges, offering ease of purchase and sale through brokerage accounts. Potential benefits of spot Bitcoin ETFs. 1. Increased accessibility. ETFs provide a familiar and accessible entry point for traditional investors who may be hesitant to venture into the unfamiliar territory of crypto exchanges. 2. Enhanced liquidity. By bringing more institutional investors into the fold, spot ETFs could increase Bitcoin's overall liquidity, potentially leading to smoother price discovery and reduced volatility. 3. Regulatory oversight. Trading through regulated exchanges offers greater investor protection compared to the sometimes murky waters of decentralized crypto exchanges. 4. Diversification. A small allocation to a Bitcoin ETF can add diversification benefits to your portfolio, potentially hedging against inflation and traditional asset correlations. 5. Convenience and security. ETFs eliminate the need for managing private keys and securing your personal Bitcoin, simplifying ownership and potentially reducing theft risks. Potential drawbacks of spot Bitcoin ETFs. 1. Volatility. Bitcoin's price swings can be dramatic, meaning even small investments in a spot ETF can be exposed to significant losses. 2. Fees. Expense ratios and other fees associated with the ETF can eat into your returns, further amplifying the impact of volatility. 3. Regulation and risks. While regulated, ETFs may still be subject to evolving regulations and unforeseen risks associated with the ever-developing crypto landscape. 4. Limited functionality. Unlike directly owning Bitcoin, ETFs cannot be used for certain applications, such as making micropayments or participating in governance protocols. 5. Counterparty risk. While ETFs hold the actual Bitcoin, relying on a custodian introduces counterparty risk, meaning potential loss if the custodian becomes insolvent. Evaluating your suitability for spot Bitcoin ETFs. Before committing to a spot Bitcoin ETF, it's crucial to evaluate your personal circumstances and financial goals. Here are some key factors to consider. 1. Risk tolerance. Can you stomach significant price swings and potentially lose your entire investment? 2. Investment horizon. Are you committed to a long-term investment strategy, given Bitcoin's inherent volatility? 3. Portfolio diversification. Does a Bitcoin ETF meaningfully diversify your existing portfolio holdings? 4. Financial goals. Does Bitcoin align with your overall financial goals and objectives? 5. Knowledge and research. Do you have sufficient understanding of Bitcoin and the associated risks before investing? Alternatives to spot Bitcoin ETFs. If you're still unsure about spot Bitcoin ETFs, here are some alternative options. 1. Directly buy Bitcoin. Owning Bitcoin directly offers full control and access to its functionalities, but comes with higher security risks and exchange complexities. 2. Futures-based Bitcoin ETFs. These track Bitcoin futures contracts, potentially offering leverage but exposing you to additional risks and complexities. 3. Bitcoin mining companies. Investing in publicly traded companies involved in Bitcoin mining may offer indirect exposure without directly owning the cryptocurrency. 4. Grayscale Bitcoin Trust, GBTC. Although not technically an ETF, GBTC is a popular option for Bitcoin exposure, but its premium to net asset value (NAV) can significantly impact returns. The bottom line here. Spot Bitcoin ETFs offer a convenient and potentially safer way to gain exposure to Bitcoin compared to direct ownership. However, their suitability depends heavily on your risk tolerance, investment goals, and understanding of the associated risks. Carefully evaluate your financial situation and conduct thorough research before making any investment decisions. Remember, Bitcoin is a highly volatile asset, and investing in it should only be considered within a diversified portfolio and with a long-term perspective.